I want to welcome our next guest to the show today. We have Bob Iaccino, the founder and chief strategist at Path Trading Partners. Bob, it's great to have you back on the show. I'm curious if you have any expectations today as far as the GDP number and your thoughts as far as what we should look for.
No, I think I look more at the preliminary and the final. I don't really look at the adjustments in the middle. I don't see much. You're probably going to get a 1/10 uptick in GDP. I don't see it affecting the markets much. The overall sort of, I don't know, the 30,000-foot view of the markets right now is a combination of what was perceived as a more hawkish Fed, which I don't necessarily agree with. And you combine that with some of the mixed data we got yesterday. The GDP is a little too far backward looking at this point for me. When you're looking at what we saw yesterday with the consumer confidence levels at a 17-year high, but durable goods dropping more than 1% lower than the expectation, down 3.7%. It's great that the consumers have confidence, but you don't get that output, or I'm sorry, the productivity increase that we need to sort of stave off the painful effects of inflation by increasing the supply of goods. You don't get that without capital spending. Durable goods is more retail based, but there is commercial capital spending that's in that number as well. So I really am shifting completely to the CapEx side from smaller commercials, away from retail. The consumer is spending, we've got to see industry spending.
Bob, tell me your thoughts about the overall theme of what we're looking at here. Obviously, a lot of people think 3%, it's just a matter of when. But some of these numbers that are coming out, they're not as strong as we want them to be. I mean, that durable goods number, now we knew it was going to be down, but we didn't think that core number was going to be minus 0.3. That's a disappointing number. Some of these are starting to miss here. Is that going to start affecting how bonds trade and that look going forward towards 3%?
Well, Kevin, here's what I meant about, I don't think we saw much of a difference yesterday. What we saw in Jay Powell was what is known from his personality and his character. He's a little more straightforward. He seemed to give the market the impression, and I don't disagree with this now, 6 months ago I would have disagreed with this, that they're more likely to come off that 3 rate hikes and go in the direction of 4 rate hikes for 2018 than they are to go in the direction of 2. Having said that, he's optimistic about the economy, but they're data dependent. I put out a piece this morning where I basically said, look, the reason I think this is no different, the statement itself, the pre-written statement, is as if Janet Yellen wrote it. Then the Q&A was a little bit more harsh than the statement. That was sort of that dichotomy that caused the spike from 285 up to 292 and change in the 10-year rates. Now you mentioned we're back in the 280s. I think that 3% is going to be sort of a phantom level. It's going to be one of those situations, you guys remember this from a few years back. Ben, I think you were still on the floor, where we'd reach certain levels in the interest rates and it was more like a sort of a oh whew moment as opposed to, okay, we're here now, everything changes. 3% is a when, but it's going to be less of a climactic event when we get there because it's perceived as a when.
Yeah, let's talk about less climactic events here. Definitely, that's what we're seeing in terms of the way the Fed is approaching some of these meetings. But I want to talk about how the market should be able to stomach a few rate hikes as long as they're gradual increases, what everyone's saying. But I'm wondering, is the Fed becoming too concerned about the market reaction to their policy decisions? Do we need to get back to the days of irrational exuberance where the Fed just acts without warning, or has the transparency really created a healthy marketplace for us?
Well, I think it's created a more healthy marketplace, except if you're short the VIX. I've maintained for a while now that Janet Yellen's biggest success to me was her ability to communicate and have that communication turn into the actual actions that the Fed took. Anytime the Fed was kind of pivoting a little bit, there was a Fed speaker or 10 that said it. They essentially said it. And through the end of Janet Yellen's tenure, I kept saying, look, this is what the Fed said, so this is what they're going to do. And she did that. Powell's on record as saying he wants to improve upon that. Now, I also think that's kind of why the VIX went to levels that we haven't seen. And it's not only that, but stayed at those levels. So the volatility compression and reduction in my mind was because of that. We're a Fed, okay, what's the right word here? We're a Fed-driven economy in the short term. We have been since about 2009. Yeah. We continue to be until rates are normalized, QE is done, and we go back to market forces, that's true data dependence, then you'll see the VIX come back. Powell's going to try and improve on that in a much more straightforward manner. That might cause early volatility like we saw yesterday, but should bring us back down to, hey, this is what he said, so this is what he's going to do.
Yeah, well, and that seems to be what we're seeing here right now is volatility. VIX is holding below 20 right now at 1813. But Bob, hang tight. I'd like to have your thoughts on the energies when we come back from the break. Again, that's Bob Iaccino, but traders, stick around because we're going to be talking about crude oil. We're going to be talking energies, inventories, and more right here on Futures with Lichtenstein and Hincks. Welcome back, traders, and I want to re-welcome our guest, Bob Iaccino, the founder and chief strategist at Path Trading Partners. Bob, let's dig right into this GDP number. We're seeing kind of limited reaction in the ES, the NASDAQ, the Dow, the Russell. They continue to hang out near the lows from yesterday. I'm actually watching that NASDAQ get bid. What are your thoughts? GDP, real GDP coming in 2.5%, but it looked like that consumer spending came in a bit hot at 3.8%.
Well, there you go. There's our data dependence, right? We're getting a little bit of a bid back in the equities, which honestly I thought we should get back yesterday. To me, it's going to be a thing. We've got to have a lot of really bad data to hurt equities because any bad data is going to keep rates in check, right, and any good data is going to go to the bottom line of corporations. 14.8% blended earnings growth rate with 90% of the S&P 500 reporting. That's pretty darn good.
Bob, this appears to me from a trading perspective like the perfect number. A little higher on the consumer spending, but lower on the GDP price index, which is the truest measure of inflation in this number, right? So it looks like we got a good solid number with lower inflation and a little stronger consumer spending. It's not surprising here that futures are firming up here.
You know, Kevin, you guys have probably looked at this, but if you go back and look at a long-term PCE chart, we essentially got below 2% right around 1992. And essentially, if you draw a 2% line across that chart on PCE, we bumped up above it maybe a handful of times. Essentially, inflation has been kept in check by structural forces, in my opinion, and not as much by monetary supply. We have had the easiest monetary sort of situation that we've had in 25 years, and we're still not getting runaway inflation. And I hate to use an overused phrase, but the Amazon effect, we'll call it originally the Groupon effect. People don't buy things without a discount anymore. It's going to be awfully tough to get prices higher for any sustained period of time.
Yeah, Bob, let's talk about the dollar right now and the reaction. We're seeing somewhat subdued reaction there as well. I'm curious, do you think that the currencies and some of these treasury products are looking forward to tomorrow's PCE number and kind of looking past this morning's GDP?
Yeah, absolutely, Ben. I think the point you make about the currencies is anyone who trades equities, anyone who trades bonds, anyone who trades commodities, you should open your currency charts first because the moves come in the currencies first. Let's go back to yesterday. If you looked at the dollar index yesterday, prior to the pre-release text, the dollar was on a slight uptrend. It wasn't crazy, but it was climbing up. Then it had a one-bar move down, and then it rocketed up just as the Q&A started, and bonds followed, treasuries followed. Now, I'm not saying they're following the dollar specifically. They're following their own set of factors. But the moves tend to happen in the currency markets, and especially if you're somebody who trades or invests in foreign bonds. You want to watch the euro, you want to watch the Swiss, you want to watch the Aussie. Currency markets will lead you sometimes, oftentimes, in the right direction when it's a big event like that.
Bob, when I transitioned from trading stocks and options and added the grain markets to my trading is when I gave into the fact that it is the US dollar that drives most trading around this world. And when the sooner that our listeners, our clients realize that it's the dollar, it's always the dollar. When they realize that, I think they'll become better traders. I think that's important in someone's progression. Give us your thoughts there.
Well, I mean, do you realize how, well, I guess you do because you said it, but how astute that comment is to mention it in context with the grain markets and the ag markets, because people eat, and they eat all over the world. Okay, they don't need to buy iPhones, but they need to eat. Well, I don't know about that. Maybe they need their iPhones over their food. My nieces do. But having said all that, when you're looking at the currencies, the dollar drives how people consume all over the world and how they consume their necessities, like energy and food. So the currencies will lead you in the generally correct direction, or at least get your sort of framing around what you want to do correct. It's a fantastic point, Kevin.
Bob, let's talk about the energies. Let's talk about the inventories report here today. Should expect to see some movement in the crude. We've been watching it hold below that 66 level. It seems like it found a bit of a support around 58. What are your thoughts in terms of the crude right now as we're watching the dollar hold upper levels?
So crude's really interesting. Couple of big news pieces in crude. Number one, Iraq has announced, I'm sure you guys have talked about it, that they're going to delay their production increase, which was scheduled for 2018. They're pushing it to 2019. That's almost another million barrels a day, taking them from right around 4 million BPD to right around 5 million BPD. And they're going to do that in 2019, stated reason because of the OPEC production cuts. So that tells me two things. Number one, Iraq's going to argue about not renewing the production cuts for 2019. I think they're going to be a pretty loud force in that argument. They also said they're delaying it because they want prices higher when they start pumping that other bunch of barrels out. Now, we saw the API yesterday, expected a 1.4 build. We got a 900 build. You're going to see a lot of misses in these inventory builds, and you're going to see a lot of draws when builds are expected. And here's why. When you look at the seasonality of crude oil's been playing out exactly as per its seasonality. We tend to go down the first week or so of February and then rally up essentially through June. For two reasons. Refineries pulling crude oil out to build up their supply of winter blend gasoline. That's why the gasoline builds aren't going to bother me as much. In order for them to have the gasoline to sell when it's time for them to retool what we call refinery turnaround to produce summer blend gasoline. So they're going to shut down and they want that winter blend. This happens every year. That's why 20 years of seasonality shows that pattern. It's the strongest seasonality push we have all year in crude oil. Can something else happen to defy that? Absolutely. There's periods in March where we go sideways. There's periods in April where we drop. Also, speculators like myself know this. So we prepare for this, we prepare for the demand from the summer driving season, and we start to actually curb some of those speculative longs in June, because that's really the peak of this seasonality. So we'll probably get a surprise in EIA as well. Even though we got a build yesterday in API, it was about, well, a little bit more than half of the build that was expected. So I think crude oil will probably go down to about 61.75. You look yesterday, we got about a 50-cent move in the dollar index, right? And we got about a 1% move in crude. So if you keep that relationship, if the dollar goes where I think it's going on the dollar index, which is about 92, and then I think it's going to turn around again, then I think we see about 61.50, 61.75 in crude oil, and then we probably get a push to the high 60s.
Bob, I want you to talk to our clients about one of the points you were making here, and that is the seasonality effect on as we get into what people call summer driving season, right? But when I think, tell me if I'm wrong here, I see late June, like that third or fourth week in June is when it seems to trail off and the seasonality turns from bullish to bearish. Do you see the same thing? Is it that third or fourth week in June?
Absolutely. It starts at about, right at about the start of the third week.
Right.
It starts to trail off. And the summer driving season doesn't heat up till late July. But it's a fallacy that the demand on crude oil actually accelerates into July. It doesn't. It starts to decline because they've generally have built up those gasoline supplies. And now we're also, by the way, still about 7 or 8 million barrels below where we were this time last year. In terms of crude oil. So as they draw that out, we're going to get further and further away from that sort of average number. Now, you're right about that. The speculators start to peel out of that stuff. And a lot of it has to do, for this year specifically, this is going to be one of the most expensive driving seasons we've hit since, well, in a while. It's going to be about $2.75 a gallon, $2.85 a gallon gas are the estimates now. And that's pretty pricey. And jet fuel has actually been steady and the airlines have hedged, so airline prices are actually pretty stable. So you might see some transition from driving to flying if it's something like Chicago to Nashville, right? Where you can get a $100 flight, but it might cost you $80 both ways in gas. So you're going to get some of that transition, so it might start a little earlier in June, but June's the target for that to trail off.
All right, Bob, we covered quite the spectrum of products here today, dollar currencies all the way into the energies, and even touched on the Treasuries a bit there. Traders, that's Bob Iaccino. He is the chief strategist at Path Trading Partners.